Okay,
Well, um,
let's see.
I just wanted to thank everybody for coming. Looks like we got a really nice turnout. Um, and Lee Spaziano has been a member of the group probably throughout the whole
Yeah.
COVID quarantine,
Yep.
and so he's been a very valuable member of the group. And he volunteered to do a segment on trading plans and setting goals, and I thought that was like a perfect
Good
topic to
timing.
start the new year. So
Yep.
with that, Lee, thanks for volunteering to do this, and it's all yours.
Absolutely. Let me press a button here and share my screen. One moment. Okay, here goes. Can everybody see my screen? It says, "Who am I?"
Yes.
Okay, great. So, who am I? Lee Spaziano, you caught that part. I started
Hmm.
trading about 30 years ago. And in that 30 years, I spent 29 of them not being very good at it. So, as I mentioned, my objective for 2020 was to learn how to be successful selling option premiums. So, that was my goal for the year. I did hundreds and hundreds of trades. I spent so many hours I can't even count watching videos, reading books, and everything else. Um, and I got good at it. And now I trade every day, and I make money just about every day. I was just telling Brian that my moving average of my return on capital for the last 20 days is 0.44% per day. So that tracks out to be 200% a year. That's pretty good, I think. I'm sure there's a lot of people making more than that. And as a matter of fact, I'm sure there's a lot of people in the room that have been trading longer than me, that have been doing option premiums a lot longer than me, that are far better at it. So the question is, why am I the guest speaker talking to you if many of you are better at trading options than me? And the answer is, I'm not going to teach you anything about how to trade. I know how to trade. I could point you to some videos. I have a 17-hour playlist of other people, and I could point you to that playlist, and you could learn how to do what I do if you don't already know. But I'm not here to talk about that at all. There's plenty of other people that can talk about that. But what I am is I'm an engineer, and I think like an engineer, I work like an engineer, and I trade like an engineer. And if you know any engineers, you know we think a little bit differently. Everything is more mechanical, more precise, more scientific, more driven by by um, research and experimentation and that sort of thing. So that's how I trade. And what I've decided is for myself, I have my own objectives. And I question, what are your investment objectives? And I think most people would say that they want consistent income. Or maybe they want consistent returns, or you could call it consistent results. But whatever it is, it's just consistency. And I think that a lot of people I see people. I saw a guy. He was trading plug. Was it plug? Whatever it was, plug. Yeah. And I took a look at the chart today, and it's parabolic. And I thought to myself, ah, I wish I could get in on that. I wish I could have bought that 3 days ago like this guy did. And he had the cojones to to actually do the trade, and I didn't. And it's not that I didn't have the nerve to do it. It's that I know to have consistency, I need to follow my trading plan. So for me, I have to follow a specific plan. Now that plan is written down. I do it to the letter. I do it day after day after day, and speculating on stocks that are going parabolic is not part of my plan. Now, because of that, I've missed out on lots and lots of opportunities. I mean, I've watched people make tons of money buying Tesla. I mean, everybody knows Tesla is just going and going and going. And every day I sit there and look at Tesla and say, how come I haven't bought any Tesla yet? So, and the answer is because it's not in my plan. My plan says to avoid parabolic stocks. It says, we call them meme stocks or FOMO stocks. My plan says to avoid them altogether. And it's not that people can't make money on them. It's that, to me, it's speculative and it's kind of hit and miss. And whatever you want to do in your own plan, that's completely fine as long as you have a specific plan that you're following to get consistent results. So To me, I'm a zealot about my plan. Um, if I want to do something that's not in my plan, I want to go change my plan because uh, I want to make a plan and stick to it so that I can get these consistent results. And I'm not going to break my own rules. Sometimes I'll refine my own rules so that I can do better going forward, but I'm not going to break my rules. And then the other thing is I like to track my results. So in a minute, we're going to take a look. But before we go any further and take a look at the plan and some spreadsheets and log files and things like that, does anybody have any questions about consistency and tracking and following a specific plan? And if you do, you'll have to unmute your microphone.
Hey, Lee,
Yes.
it's really not a question, but if you could post the playlist of the videos you mentioned,
Hmm.
if you want to either post them in here or post them in the Facebook group.
Absolutely. I'll tell you just a little bit about it. Somebody asked me how to trade options for consistent credits, and I put together a list of a whole bunch of other people's videos. It's a big long list of videos that shows exactly how. And some of them are what's his name? Matt and his whiteboard. Is that his name? And some of them are option alpha. There's just a nice mix of videos that brings you start to finish through the whole process of trading options. Okay, so I'll put that list up on the Facebook page, or I'll email it to you so you can send it out to the group.
Perfect, thank you.
Okay, so I'm going to close this and we'll take a look at my plan. Okay, so here it is. This is a PDF file of my personal options trading plan. And this file, if you see here, it's got lots and lots of pages. I'm scrolling through it faster than you can read it. 17 pages of trading. How I trade, what rules I follow, why I follow them. And I'm not recommending to anybody that you make a 17-page trading plan. But what I am recommending to you is that you decide what kind of trading you want to do and write it down and stick to it. So this, what I call the options playbook, is just an example of a trading plan. You could take bits and pieces of this and you could use it yourself. You could decide that you just want to do one strategy or another strategy, but I've decided that this is the list of strategies that I want to use. So my objective in trading is to use complex option strategies to take advantage of options Greeks, especially theta and vega, using the following strategies. And I do calendar spreads, strangles, iron condors, credit spreads. I do the SPX 7DTE bull put spread, and I do the wheel. Those are the only strategies that I do, and the rules that I follow for doing those strategies are outlined in this document pretty consistently. I know, Tammy, you do the 0 DTE strategy, and I know that you use a very specific set of rules. Is that right?
Absolutely.
Can you give me an example of what kind of rules that you use on your 0 DTE SPX?
Well, I have rules for entry and what I look for entry, and I have rules for what happens when the trade goes against me, and I have rules for sizing and how many contracts I do. Pretty much everything I do is a rule,
Right.
and anything related to the trade.
Okay. Is anybody else out there using a very specific set of trading rules for their strategies? Well, okay. So, yeah, who was that?
I was going to say, yeah, I mean, I have rules for my my wheel strategy. I'm going to probably take a look at yours. I do an ex-dividend strategy, and I do a lot of credit spreads. So those are my kind of
Right.
three main trading strategies. And yes, I have like real, strong rules for entry, exit, those kind of things. And I think you mentioned earlier about keeping track of your
Yep.
results. I think that's a critical kind
Yeah.
of piece too.
Absolutely. I'm going to show you my trading log, and if anybody else wants to share a trading log, then maybe we can do a screen share from your trading log later on. Okay, so calendar spreads. they're kind of hit and miss, and I'm not sure I even want them in my trading plan. But I'm going to follow these rules, and using logging and tracking, I'm going to see how successful these rules are and decide whether or not to tweak the rules or to get rid of it altogether. I think I've decided to get rid of iron condors, which is interesting because I cut my teeth on iron condors. But as I go on further and further, I'm liking them less and less. And perhaps some of these strategies are better in certain years than other years. Maybe an iron condor is a 2021 trading strategy where it wasn't the optimal choice for 2020. I don't know. Anyway, so in general, each of these strategies has their own rules, but then I have some overarching rules. So for me, rule number one is no speculating. I guess Warren Buffett's rule number one is don't lose money. I guess that would be a great rule one if I could do it, but for now it's no speculating. And what that means is that I shouldn't be trying to predict market movements as a primary part of my strategy. Markets are chaotic and they're unpredictable. We can do a certain number of things using probability theory, and we know the market range based on the wisdom of crowds, based on the law of large numbers, but there's not much that I trust in the realm of technical analysis. So my plan pretty explicitly says stop trying to predict the future. Indicators do not have predictive power. And people have called me out on that. They've said, look, Lee, I think you're wrong. I'm able to make a lot of money by predicting which way markets are going. And that might be true, but if they're primarily predicting that markets are going up, well, guess what? Markets primarily go up, so that's a good prediction. Now, and you might also say you have to have an underlying outlook of the stock, or else you don't know which play to make. And that's true. But if you were to do, for example, a put credit spread, you're bullish on the stock, but you don't have to be right. It doesn't have to shoot up. It doesn't. It could go up a little. It could go up a lot. It could stay flat. It could even go down a little. So I am predicting that it won't drop by a lot, but I'm not predicting that it's going to shoot up. And my investing is not based on speculation. It's based on probability statistics. And as a matter of fact, rule number 2 says we're profiting from probability, right? It's all based on the Greeks for me. I'm not saying that you should do the same thing, but what I am saying is I have rules. No speculating. Profit comes from probability. Number 3 has to do with liquidity, and we don't have to get into the details of it, but I pretty much only trade underlyings with high liquidity, things with tight bid-ask spread. Let's see, I have to hit a button. Okay, I have rules for entry and exit, when I should exit, when I should enter. I have rules for picking underlyings, and one of my rules is no FOMO stocks. Everybody knows what FOMO means, fear of missing out, like Tesla and Plug and others. and you know what? Well, part of this is controlling your emotions, right? One of the main reasons to have a plan is to keep your emotions in check. I would love to go out and buy Plug today. It's on my mind. I was looking at it before the market opened. I was looking at it when the market closed. I looked at it twice during the day, and it's FOMO, fear of missing out. I'm afraid that I've missed out on the opportunity to get in on Plug. But I can feel better about missing out on that opportunity because my plan specifically says to avoid stocks like that. Stocks that I'm afraid of missing out on, I don't want to have anything to do with them because it's a double-edged sword. So I have lots of rules for picking underlyings. Let's see, I have rules for dealing with risk management. I have to understand tail risk. I have to understand correlation. I have to understand position size and hedging and account allocation. So these are all rules in general of how to manage my trading account in my trading. And furthermore, I have these different strategies, and I use a specific management of how much capital goes into each of the strategies. It's kind of a wide range, but at times I'm doing 10% of my account in the SPX 7 DTE. And some people might say, wow, that's crazy. You're going to risk 7% of your account on, excuse me, 10% of your account on a binary win or lose? And the answer is, yeah, I know, because the math has worked. Historically, it's paid off. So I might lose 10% one week, but the next week I can make it back. And on average, this wins way more than it loses. So if I didn't have my trading plan and I didn't have these back tests to prove this to myself, I wouldn't have the nerve to invest that much money in this particular investment. But because the research backs it up, and because my trading plan says, yes, it's okay, do this, I can do it. Okay, any questions before I move on to the individual strategies? Okay, here we go. So the first strategy I use is the calendar spread, or diagonals. And I go into some detail explaining to myself why I'm doing it and what I'm looking for, and some explanations of why it works and what I care about. And I show myself, because this is who it's for, right? I show myself some back tests and some research and things to support my trading strategy. And then on the next page, I talk about variations of the trading strategy, diagonals and double diagonals. And then I start to make rules. Calendars work a little bit best out of the money. That's just my personal rule. For me, for my strategy, they work best a little out of the money. Calendars are a low volatility play, and I know that because I've done a lot of back tests, and you can see this is a chart of the average profit and loss versus IVR. And what you can see is, doing calendar spreads, if the IVR gets above 40%, calendar spreads, if the average profit, let me say that again. If the IVR gets above 40%, the average profit and loss is negative. And if it stays 40% and below for IVR, they're profitable. And if you look at this small chart that's broken down into higher granularity, what you can see is, if the IVR is 2.5%, the average profit and loss is huge, 250% on these. So I know that the lower the IVR, the higher my probability of winning on this is. And Brian, if you recall the other day, you were doing a Home Depot trade. And I said, you know what, I like that Home Depot trade. It's nice and flat, and it's in a nice range. I would like to trade it, but the IVR was a little bit low. So instead of doing a credit spread or a strangle or anything like that, I decided that the best play was to do a double calendar on that. And I'm expecting IV to expand. Anyway, it doesn't matter if I'm right or if I'm wrong, or if you want to do it this way or not. What matters is that that I have my plan and I'm sticking to it, and I am going to follow my rules for how to do a calendar. Anyway, so going down, there's a little bit about trade management, and then I have a calendar checklist, and I ask myself these questions. They have to be true, or else I can't do this trade. Is the front month and the back month about 30 days apart? Is the front month 30 to 50 DTE? Is the probability of profit greater than 50%? And I go down my list. Is IV in contango? Is IVR below 30? Are the strikes consistent with my outlook and directional bias? Is the total risk somewhere between 2 to 4% of my account? Is the position overly correlated with the other items that I'm already holding? Does the beta weighted delta bring me more neutral, or does it make me bullish or bearish in the market? Are the strikes liquid enough? Are my strikes out of the money? This is my checklist, and I can't do a calendar spread unless I can check off all of these boxes. That's just my rules. So I'm pretty zealous about it. I follow these rules, and if I want to break these rules, I have to go change my plan, change my checklist, change my criteria. Okay, everybody with me? Okay, so a lot of people might say, well, perhaps I've overdone it. Maybe I didn't need to go into this much detail. Maybe I didn't need to lay it all out, it written down. You know how to do a calendar spread. You don't need a checklist before you place your order. You know how to do calendar spreads. You don't need to write down what your criteria are. You know what a good calendar spread looks like, right? But the answer to that is, but do you really? Can you be consistent from trade to trade to trade, doing what you know works if you're not following your own process? And if you know so well what makes a calendar spread work, can you articulate it? Can you put it down on paper so that you can follow those rules every single time? Hey, I just realized I set up this light so you people could see me. Look at that.
There
Okay.
you are.
Look at that. Okay, so does anybody have any questions about this before I move on to the next section?
Hey, Lee.
Yes.
So if somebody was just starting out and they had a checklist, do you kind of view it as a dynamic document, like you add additional things as you kind of learn them?
Absolutely. Absolutely. I've changed this document probably 30 times. I changed the checklists. I changed the criteria. I changed the management rules. That kind of raises the question, why have a list at all if you can just change it willy-nilly? But the answer is, every day that you're doing trading, you're learning. And when you learn, you have to adjust. And also the markets are changing. So perhaps you need to adjust your strategies to match the market. But absolutely, this is a living, dynamic document. I follow it precisely, but I change it as necessary. Tammy, about your 0 DTE, I imagine you've been fine-tuning that for quite a while. Are you still changing your rules?
Oh, absolutely.
Okay.
Yeah. I mean, I learn things every day trading it, and people ask me questions about it, and it makes me look at it in a different way. And I'm constantly testing and trying out new things. So yes, the rules are not static. They will change and hopefully just continue to improve the strategy.
Yep. Okay, so the next section here is, let's see, it looks like a short strangle strategy. And my rules are specific for this as well. It's reserved for high IV underlyings. And I explain what IV is and what I mean by high and why it matters that it's high. I make a rule for how much premium I have to be able to collect. What am I looking at? Strangle. Yeah. I talk about my target strikes for strangles. I like to do somewhere between 16 and 30. But really, this is these strikes are near or just outside the expected move, or another way of saying it is it's around one standard deviation. So that puts me at about a 20 delta. I do take a look at the historical levels of support and resistance. I know that contradicts earlier parts of the plan. I don't put much stock in technical analysis, but still, if I'm going to come up with an outlook about what strikes I want to take, I personally like to see a little bit of support and resistance near my strikes if I'm going to do this. I don't believe that it holds much water, but maybe a little. Maybe it makes me feel better. I don't know. My strangles, I like to keep them neutrally biased. I don't always do them neutrally biased. Sometimes I have kind of a call skew, but when you use deltas to specify your strikes, that will give you a bias that matches the wisdom of crowds bias. I mean, one standard deviation to the left and one standard deviation to the right aren't necessarily the same number of dollars. It's the same number of deltas, but not the same number of dollars. So when I say neutrally biased, I'm talking about delta neutrally biased. For my strangles, I target 45 DTE, anywhere from 30 to 65. And again, it depends on the time of the month, when the options expire, and so forth. I only trade the high liquidity, and I have my rules for management. So these are all the rules for my strangles. And then I have my iron condor strategy. And I don't think that it's necessarily a good idea for people to trade a bunch of different strategies. I think it's probably a better idea for somebody to get really good at one strategy. But the way I've done it, I can look at an underlying and see which strategy I think is the right fit for that underlying. If you only have one strategy, say put credit spreads, well, you need a bullish underlying to use that strategy. Suppose I'm not bullish, suppose I'm bearish. Well, then I would use a call credit spread instead. If I didn't know how to do both of those strategies, I wouldn't have the ability to take advantage of those two different outlooks. And likewise, all of these different strategies kind of have their own little niche in taking advantage of a certain situation. That's why I like all these different strategies. Anybody else? Bud, how many strategies do you like to trade?
About 3.
3? Okay, what are your favorite strategies that you like?
I like the credit spread, and one that in the money.
Sure.
I like the covered calls. And I'm trying to think of what the third one was. Covered call.
Okay,
So-
gotcha. Now I know Brian said he likes wheels. Anybody else want to chime in on how many different strategies they trade? Dennis was sitting in the waiting room. I just let him in. Hey Dennis, welcome to the meeting. Okay, so anyway, moving on. So there's...
They
Yep.
just so you know, Carrie replied she trades 2 different strategies.
Okay, great.
Carrie's.
What are those 2 strategies that she likes? She or he? Did you say Carrie or Carrie?
Carys.
Ah, Carrie Smith.
Carrie, yeah.
Yep. 2 different strategies. Okay. I didn't even know Carrie was on. Hey Carrie, how are you? Okay, here we go. So moving on, I have rules: management and defense, target strikes, collect a good credit for acceptable profit and loss, and what specifically that means. I'm looking for a specific edge. That means a certain max profit and loss versus the probability of profit, and I do the math on it. I actually do the math to see if this meets my criteria, and again, this comes down to a checklist. Is the IVR above 22? Are the strikes liquid? Is the expiration in range? Is the edge greater than my criteria? Is the profit and loss ratio meet my criteria? All of these specific rules. I won't do an iron condor unless it meets these rules. And one of the reasons I don't like iron condors as much as I used to is it's very binary. When you have a narrow spread iron condor, it tends to want to be a max loss or a max gain, and there's not a lot in between when you have like a $1 spread. And you might say, well, make it a wider spread, make it a $5 spread or a $10 spread. But when I start to make a wider spread, it starts to act more like a strangle than an iron condor. The wider it is, the more it feels like a strangle. And I thought to myself, you know what? I think I just like strangles better. So I've kind of drifted away from iron condors. But anyway, when I do trade iron condors, these are my rules. These are my deltas. These are my pop. This is my edge, and I just follow this set of rules. Okay, so there's a credit spread strategy, and you know a credit spread is 1/2 of an iron condor. So this information for a credit spread is almost identical to an iron condor. One of the differences is that it has a different outlook. and it has a set of rules, credit spread checklist. And I know I'm going kind of fast. The next trade that I like to do, the next strategy that I like to do, I picked up from Eric in his group. He did some research on an SPX 7DTE at 48 delta with a $5 bull put spread. And I liked his research so much that I ended up grabbing the data and doing my own set of research. And this trade is actually amazing. We do it on just Wednesdays because historically speaking, Wednesdays are the best day to trade the 7DTE bull put spread in SPX. Don't know why. We have some speculations that maybe because lots of things are closing on Friday, there's market forces that come into play, and on Monday we have the effect of the weekend. But on Wednesday, it seems like the market is more stable and consistent and going upward. So the question is, what does that even look like? So in my back test, I did a histogram. I looked at week after week after week of the SPX 7-day credit spread. And what I found, if I look real close here, is that on average, what we can see that the bell curve, the histogram of the SPX is going up. You can see that right here are the weeks that it's gone down, and from here over are the weeks that have gone up. And you can see that the vast majority of weeks that have passed, SPX went up. So if you're going to bet on SPX, whether it's going to go up or down, you better be betting that it's going up, because on average it is. And I was able to take that data and make a normal distribution curve based on its mean and standard deviation, and come up with this. It says normal. It's actually a log normal distribution curve. It's hard to see from looking at this, but it doesn't matter. This is the distribution of what SPX is going to do. And you can see that most times it's going up. It goes up a lot more often than it goes down. So I think that's part of the principle of the 0DTE trade too, is that there's going to be more up days than down days. And if you think about it, if it's kind of a binary trade where you either won or you lost, if your win count is greater than your lose count, then you're making some money. It doesn't matter to me that on a bad week it drops 10% and on a good week it goes up 1%. I don't care. I'll take those 1% week after week after week, and then I'll have a bad week and I'll lose. And no matter how much it drops, I only lose once, because it's a defined risk strategy where I can't lose any more than has been assigned to the spread to begin with. Anyway, so historically I've charted that out, and you can see that if you apply it to an account, you end up with a graph that looks just like this. There's all of my research and my justification for why I'm doing this trade, and the back tests that describe why I've chosen these specific parameters. So if you scroll down and you look at here, this is a chart that shows the average profit at given deltas, and this is a really interesting chart for me. If you do a 40 delta bull put spread and a 65 delta bull put spread, what you can see is on average you make the same amount of money for all of those deltas. I mean, who would have thought? If I said a 40 delta means that you have a 40% chance of being in the money, so you're going to be right and win 60% of the time, and a 65 delta, you only have a 35% chance of winning. You would think that the 40 delta would pay a lot better, but because of the way IV works, because of the way option premiums are priced, it turns out that the extra premium that you get at a 65 delta offsets your probability of profit, such that everything in this range has about the same amount of profit. It's only this is the most interesting bit. When you get down to a 20 delta, It has the lowest amount of profit. You would think 20 delta, that's the safest thing I can buy. I'm always going to buy a 20 delta, excuse me, I'm always going to sell a 20 delta, and then I'll never be in the money, and I'll always just keep the option premium, and I'll make money. I'll collect premium week after week after week after week, right? That's what makes sense. 80% of the time, you're going to be right. Well, because 80% of the time you're going to be right, it also pays the least. But not only does it pay the least, it pays the least disproportionately to its probability of actually happening. And without doing the research in the back test, I wouldn't have this data to know that I don't want to do a 20 delta SPX ever. The lowest SPX credit spread I'll do is a 40 delta, but I'm perfectly willing to go up to a 65. I'll win less often, but when I do, I make more money, and it all balances out. Anyway, and none of that matters. I mean, you don't need a lecture on how to trade SPX. My point here is that I've done my research, I've written down what my strategy is, and I follow it. You don't have to do your own research. You can go to Tasty Trade. They have their research group, and they publish research papers every day. And there's podcasts that are out there. Option Alpha does research. Eric does research. There's lots of companies out there publishing their research on what they do, and you can use their research to do it. But what I highly recommend is that you've looked at some research, you decide precisely what you want to do and why you want to do it, write it down and do it. Don't say, this week I feel like doing this and next week I feel like doing that, because then you can't have consistent profits.
Lee?
Yeah.
Would you agree that each person has a certain kind of style that they're comfortable with? So you may say, I'm okay with a 65% delta and I win a lower percentage, but then you might have someone that says, I really need to win a lot and make, just from a psychological standpoint that,
Yeah.
So in terms of developing plans, you want to make sure that it's kind of centered upon your risk tolerance and your trading style.
Absolutely. Your tolerance for risk, perhaps your age has to do with your tolerance of risk. What percentage drawdown can you tolerate? Perhaps just what allows you to sleep at night. I'll tell you, when on Tuesday nights, it's a lot harder to sleep knowing that my 7 DTE option expires tomorrow. And not everybody can stomach that. I think it's important for you to know what your strategy is, to know what your criteria is, and whatever it is, no matter how aggressive it is or how safe it is, it should be consistent. You should do it. You should do it time after time after time again, because that's what it is. Consistent profits. This is paychecks. This is consistent annual growth on your account. And if you're going to be consistent, then you have to follow your plan consistently. And I can make recommendations based on what my plan is, but you have to have your own plan based on your risk tolerance. Oh, and this next chart is kind of interesting. It's a graph showing the different deltas side by side. And what you can see is some of the most profitable strategies also have the highest drawdown. And if you can't stomach this drawdown, then you better not do this strategy with this delta. And that goes hand in hand with what you were saying. You have to be comfortable with your strategy. Okay, so filters. Here are my rules. Historical win rates, more rules about management, rules about lot size, and everything else. And then we can get into the checklist for this. Is it expiring in 7 days? Is the delta this? Is the put that? Total risk this? And I have one other rule. No big deal. Anyway, any questions about what I've presented so far before I move on to the next bit? Okay, good enough. So, to set that aside, that's my trading rules, my trading plan, and I don't necessarily recommend any particular trading style, only that you make a plan, you write down your strategies, you write down your rules, and you stick to it for consistent returns. Now the second part of that is logging your results. There's a lot of different ways to log your results. I personally use this software called Evernote. Evernote is an online, I don't even know how to describe it. It's an online note-taking software. I can, let's see, it's best if I show you an example. If I add a new note, I can give it a title, and then I can start writing stuff down. That's it. That's kind of all it does, and it's just hitting save. It's not too fancy, but the reason I use it is because I can get to it no matter where I am. I can get to it from my phone, I can get to it from my house, I can get to it from my office, and it's just convenient for me. I can share it with other people and things like that. Okay, so I'll move that to the trash. Okay, I have checklists in here where I can write down, I can double check against my criteria. So now this is actually a copy of what's in my trading plan, but I don't have to open my trading plan every time. I can just come here and check my checklist. And here's a trading journal. So let's take a look at one. I think I had SQ open. So on Square, I did a strangle, and this is the title. It's a Square Strangle 1016 Delta 51 DTE. And on Wednesday, December 30th, my thoughts were that a very wide neutral delta position with big premiums. That's what I'm looking at, because the if you look here, the IVR was 24.5, and it was on a bit of a retracement, however you spell retracement. Apparently I spelled it wrong, and it might go up from here, and it has decent IVR, 24.4, 24.5. Anyway, so I did this trade, and this was the date and time that I did the trade. This was the underlying price. This was the underlying IVR. This was the expected move, and this was a strangle, so there were two legs. So I did a short put and a short call, and they were both sell to open. And in this case, I just did one lot of each. Here's the expiration date. It's good for 51 days. My strikes were 170 and 270, and the deltas were 10 and 16. My buying power effect was $2,164, and my credit was $570, and my fees were $2.30, and it had a 78% probability of profit. So some time goes by. On January 8th, it moved against me in some way. So what I did was I bought to close my short put, and I sold to open a new short put. And my note here says I rolled it up. My put had moved from 10 to 3. So I sold my 3 delta put, I bought to close my 3 delta put, and I sold to open a new 12 delta put, and I collected an additional $2.30 or $230 in credit. And I made a note. Friday, 1/8, made some adjustments. Square moved way up against me from this price to that price, and blah blah blah. So what you can see here is that why do I have this kind of detail? Because later on I want to go into my closed trades, and I want to see what happened. Let's see here. Let's go to a good one. Here is Caterpillar. On December 22nd, I decided I was going to do a call calendar on Caterpillar. It was 4% out of the money for the strikes, and because it was a calendar spread, my front month had a 31 delta, and my back month had a 40 delta, and the front month was 24 DTE, and the back month was 59 DTE. Here were my thoughts on entry, and one of my main thoughts here was that Caterpillar had a very low IVR, only 13.2. So my thought was this was a good time to do a calendar spread on it. And what I said is I'm going to let it ride until the front month expires. So here's what I did. On the 22nd, the price was 178. The IVR was 13. The expected moves were 9.6 and 15.8 respectively. There was a short call and a long call. One was a sell to open, one was a buy to open. 24. They were both at the 185 strike, and my max loss was going to be $309 on this trade, and my probability of profit was 51%. So the trade plays out, and let's see if I did this here on the 5th, January 5th. Is that expiration? That's close enough to expiration. On that date, the price had moved up to 185. Now, to put this in perspective, it was at 178. My strikes were at 185, and it hit the price of 185. That's real close to what was going to be my maximum profit. Now, the other aspect of it, IVR was 13.2, and it expanded up to 19.1. So when you have IV expansion on a calendar spread, it helps you to be a lot more profitable. So I closed both legs, and look at this, there was still 10 days left, 10 days and 45 days. The delta, interestingly enough, it was 31 and 40, and now it's 49 and 48. And I was able to buy that. I collected a credit of $412, and that means that I made a profit and loss of $100.04. My return on capital, that's $100 divided by my initial investment of $309, is return on capital is 32.5%. And I don't know why I keep track of this silly thing. My annualized ROI is 153,000%. It's kind of a silly number. I'm probably going to stop tracking it because they always get calculated out to close to infinity on these winners. But I can look at this and I can say, here is a calendar spread that I know worked. So if I have some other calendar spreads in the future that don't work, I can come back to this one and I can say, what made this a good trade? What did I like about it? Did I follow my rules? Do I need to update my rules? And if we scroll down the list, one of these should be marked with a loser. Here we go. This one's marked loser. I don't have many losers in here. I did an American Airlines naked call, and I lost $59.19. Not very much, but it was a loser. My return on capital was negative 13%. And I can come back and I can look at this in my log file and see, why was it a loser? What can I rethink about this type of transaction, and how can I change my rules to avoid these kinds of losers in the future? And sometimes you can't. Sometimes it's just the way it is. You're going to have some losers. But it's good to have a log so you can keep track of those things, so you know what adjustments to make going forward. Carrie, do you have your microphone on? I know you keep a log of all of your trades. Is that right? Carrie Smith, I know you're out there. Okay, somebody else. Does anybody else keep a log of all of their trades and what they do?
I definitely do. And I sort them, like I keep all mine on one long spreadsheet.
Okay.
And I keep track of how many of each type of trade I do, and how those perform over time, or how I've performed trading them.
Mm-hmm.
And I can look back and say, man, I shouldn't be trading iron butterflies anymore.
Yeah.
Because I can see the total for the year and kind of keep track of that. And so, in addition to looking at individual trades like you're doing, I think it helps too to get a big picture of, how you're doing on various trades overall, and what's working and what's not working.
Absolutely.
It gives you some good feedback.
Absolutely.
Lee?
How about other people? Do you keep a book like this?
Can you hear me?
Oh yeah, Harry. Hey there, Gary.
So one of the things that I track in my log is my emotional state when I enter and exit the trade, especially if I don't follow my rules.
Mm-hmm.
So I found that it's good for me to track what was I thinking at the time I entered. Did I follow my rules? So I just find it's good to go back and look at that part of the log with regards to my trades.
And Carrie, how do you keep track of your trades? Is it a spreadsheet? Is it a book? Is it Post-it notes? What are you doing?
I use Google Sheets.
Okay, very good. Very good. Brian, do you track your trades?
I do. I do them on Google Sheets as well. And what I think kind of to Tammy's point, I list all my trades out, especially my close trades by strategy, so I can see how I did each particular week by strategy. And then I have different tabs for different strategies.
Yep.
Yeah, I do the same thing. I have a tab for each strategy.
So I'm hearing some consistency among the group that people are aggregating the results of specific strategies. Very good. Very good. I mean, because if you don't keep track, how do you know?
Hey,
And
Lee,
it's important to review it as well. So it's one thing to track it, but like at the end of the week, I like to go through it.
Yeah.
yeah, I think that's a great point, Carrie. On Friday afternoon, when things start to wind down, I think or right after the close on Friday, if you can still stand being in front of your computer. It's a great thing to kind of look and see, well, how did I do this week? What trades cost me some money, and which ones did I do really well in?
Yep. Absolutely.
Yeah, this is Dennis.
Hey, Dennis.
I keep a journal Tommy Amendola and I developed, and in fact, I went and got another couple hundred pages today, and it just contains everything that I need, and then I keep them together week by week and then month by month and go through them. But another thing that I use is a software program called Wingman.
Yep.
I don't know and that breaks down you just click on a couple of buttons and it takes all of your trades and breaks them down by strategy and success rate. So that's in addition to the journal.
Yep. Yep. Very good.
I do have a question for you though. On your trades, on your plans, depending on the strategy. I know you're looking at pop. Are you looking at pop 50 or anything like that? The tasty trade probability of hitting 50%?
I generally don't look at that. I see it, and I know that it's always a few percentage points higher than pop, so I thought, okay, I'll just keep that in the back of my mind. If you're going to manage at 50%, then that's probably a more important number than the pop.
Than the pop.
Yeah.
Do you have specific minimum pops that you use?
So each strategy has its own
stuff that are 65.
Yeah, each strategy has its own specific minimum pop. The strangles, I want to have a very high probability of profit because you have unlimited risk. But on the other hand, my iron condors, I'm not as concerned about the probability of profit. What I'm concerned about is the max loss versus min loss divided by the probability of profit, because that calculates the edge. So for instance, on an iron condor, I might have a 80% probability of profit, but my profit loss ratio, if it's less than 20%, it's a losing trade, right? But on the other hand, if I have a 50% probability of profit, but a 60% profit and loss ratio, that's a winning trade. So with some of these defined risk trades, the probability of profit isn't as important to me as the edge that's associated with it. And I think I still have that open. Let me go back to these rules for just a second. Iron Condor checklist. So here I look for an edge, and that's my edge has to be greater than 1.0, where edge equals max profit and loss divided by 1 minus the probability of profit, right? So whereas in the strangle I'm looking for a high pop, in an iron condor I'm looking for a high edge regardless of pop.
Thank you.
Sure. Okay, so as you can see, there's a lot of different ways to make a trading plan. You can have it be verbose, or you can have it be kind of skinny. I like verbose because I'm an engineer. You might want something less verbose, and that's fine. If you don't want a 17-page trading plan, I don't blame you. Most people probably won't, but I would encourage you to have at least a 2 or a 3 or a 5-page trading plan. You might not want to log every detail of every trade. You might not want to log what Carrie does of what you were emotionally feeling when you took the trade, where and you might not want to log what I log, what was the delta, what were the commissions, what were all of these things. But I would encourage you to decide what you want to log and actually do it. So I would encourage you to have a trading plan, no matter how thick or thin. I would encourage you to have a log, no matter how verbose or skinny. I would encourage you to have a written checklist that you can follow, no matter how strict or laissez-faire. These things should be on paper, and you should be using them to get consistent results. Now, if you don't want consistent results, then you don't have to follow these rules. So, okay, well, that's about all I have. Brian, you got anything else you want to talk about?
Um, just one question. When you start your day or start your trading week, do you start out and say, I want to do, one credit spread every day. I want to do 5 a week. I want to do so many strangles. Or do you just kind of see how it goes?
That's a great question. What I personally do, I'm not sure is the best choice for everybody else, but I look at my buying power and I decide how much I have to play with. And if I have money that I need to put to use, then I start looking for a trade. And if I don't have money to put to use, then I start thinking about how I'm going to manage and exit my trades. So right now my buying power is a little bit low. I don't have money for the next trade. All of the money that I'm willing to put into use is in use. So I'm not looking for a trade. When something closes out, which often happens automatically when I'm not paying attention, then I start looking for a new trade. And the way I do it, it's kind of crazy. What I wait is for somebody like Brian to post what he's trading, and there's all day, every day on these groups, the covered call group, the wheel group, the vertical option group, the winter park group. All of these groups have people that are saying, I'm buying this today and I'm buying that today, and I just take a look at the tickers that they're using. I go take a look at the chart, and I go take a look at the IV, and I decide which strategy to apply to it. Yesterday, was it yesterday? I think it was yesterday. I went to Google. I had some money. I wanted to do a play. I went to Google and I typed in, which stock should I buy? And the first thing was an article that said top 10 stocks to buy for 2021. And the number one on the list was Adobe. I went and looked at Adobe, had a nice flat chart, and I said, oh, look at that. It's just perfect for a strangle. And I went and did a strangle. And that was that.
Yeah. Hey, Lee, there was a question about what percentage of your buying power do you keep in reserve?
Right. That's a good question. So when it comes to these high risk kind of binary spreads where you have the opportunity to lose your entire investment, I don't like to have too many of those. If you have 100% of your account allocated in trades that you can lose 100%, that would be bad. You can get wiped out in a single day. I don't like blowing up accounts. I have no intention of doing it. So what I'd like to do is keep something like 80% in cash. Now, 80% in cash would be a total waste of money, just sitting there doing absolutely nothing. So I've decided instead of cash, I'll put it into conservative investments. And what I would call a conservative investment is just holding some long-term stocks. Except I don't like holding long-term stocks. So what I do is I wheel long-term, steady, good stocks. So the answer is I don't keep much cash. I keep about 20% in what I would call high risk Not high risk because it has a low probability of profit. Not high risk because I don't think it's going to win. It's high risk because if the trade goes wrong, I could lose 100% of the investment. So I have about something like 20% in high risk, and I have about 80% in what I would call low risk, which is a stock that I'm wheeling. And that changes. That's subject to change. It's in my plan. I have to go back and look at it.
You're good.
What about everybody else? What do people keep a bunch of cash on hand, ready for a retracement so they can buy the next deal?
Brian, quick question for you. Are you recording this?
Yes. Lee
Are you
is.
recording? I'm sorry?
Lee is recording it.
Lee's recording it.
Yes.
Are you gonna be able to put it up on the MeetUp site?
Absolutely.
I mean, I've had the options playbook. In fact, I printed it out, I think, 3 times, and I mentioned to Brian, you ought to have Lee go through it. So he did follow my instructions.
For once, I'll tell you.
For once. I was gonna say, do you always take the opposite side of Brian's trade?
You know,
That's the way to do it.
Brian trades pretty conservatively, and I wouldn't say I'd take the
Oh.
opposite approach, but I definitely I get a lot of trade ideas from Brian because Brian does research on Sundays, and I don't.
I mean, I think that's kind of the cool thing about trading. You can take a trade idea and make it your own. And like if you're old like me, you make them more conservative.
Yeah. Well, all right. Well, great meeting. Thank you very much for having me. And if
you,
anybody
Lee.
has any questions for me, you can reach out to me on the Facebook group, or you can send me an email. My email address is lee@spaziano.me, M-E.
Thank you, Lee. Appreciate your putting this together.
Yep, absolutely. Thank you. All right.
Thanks, Lee. Lots of good things to think about.
Thanks, Tammy. All right.
Y'all have a good evening.
Good night.
Bye bye.
Take care. Thanks, Lee.